Hello, everyone, and welcome back to Your Finance TV. It's always a special every month. We get the monthly from Jay Pelosky. How are you, Jay?
Good, Scott. How are you, buddy? Good to see you.
It's good to see you as well. I'm good. Now, you've put a tongue twister in for a title, and it's not really fair for people with an accent like mine to try and get this one out. So I'm not even going to try. I'm going to let you jump straight into it.
Okay. Well, yeah, you're right. It was a little bit of a tongue twister, but the title of the monthly is will policy continuity trump political discontinuity? And
Yes.
basically, look, it's pretty straightforward, right? Trump is a agent of change, a chaos agent, a guy who does things his own way, and so clearly political discontinuity. And the question then becomes, will the policy continuity stay the same? And remember, our 2025 outlook is all about continuity, right? Our view is that we're early in a bull market for global equities. We're early in a global growth cycle, what we called the 2023 to 2027 long cycle. That was the title of our outlook, long cycle. And very importantly, political continuity leads to policy continuity, which leads to economic continuity, which leads to market continuity through the earnings channel. So that all kind of makes sense. And frankly, some of it was predicated on Vice President Harris sustaining political continuity in the U.S. And that was a view that we got wrong. And we had the pleasure of explaining why in real time on Bloomberg TV election night, which was quite the experience. But here we are. We're investors. We have to live in reality. We have to move forward. And so, really, as we thought about the monthly and thought about trying to integrate all this stuff, that idea of will policy continuity, because Trump clearly is going to go for growth, right? There's no, we talked about on Bloomberg a hothouse effect, right? Where you have an already strong U.S. economy. The Atlanta Fed Q4 GDP nowcast just came out 2.6%. Keep in mind, potential growth for the U.S. is thought to be around 2%. So arguably, you have an economy that already is growing above potential and above trend. And now you have a new president who is really intent on stimulating growth even further through tax cuts, through deregulation, through perhaps tariffs. So it's very debatable about whether that is pro-growth. And then also the whole question around deportation and what that means for an already tight labor market in the U.S. So that's really the debate. And it extends into the question of, U.S. is valued here at this point as an exceptional return vehicle, right? If you look at the dollar, it's strong relative to both developed and emerging currencies. The yen and the euro are thought to be 40 to 50% undervalued by many. So the dollar is very expensive. Foreign investors have never owned more of U.S. assets, both stocks and bonds, corporate credit, treasuries, than they do currently. And at the same time, you have an equity market that is valued at 22 times, 23 times forward earnings. Again, very, very expensive relative to history and certainly relative to the rest of the world. So one of the ways we're thinking about things is, if the U.S. is becoming less exceptional in terms of its political mix, and I think clearly one of the things we're focused on here is kind of the nature of several of the president-elect's nominees around defense, health, intelligence, justice, none of whom arguably are qualified or would even be thought of as potential nominees under any prior administration. And that is concerning because if the U.S. is becoming less exceptional from a political and legal social point of view, can its assets, financial assets, retain that exceptional valuation? And so one of the ways to kind of finish up the front section of our chat here, one of the things we're thinking about now is the potential for Trump to be more of an accelerator of change outside the United States more than inside the United States. In other words, because clearly with nominees like the ones he's put forward, he's not really focused on trying to get things moving quickly, because there's going to be strong disagreement on almost all of those, at least those four I mentioned. But outside the United States, is Trump, with all the concerns about tariffs, et cetera, in Europe and in China, could he be a stimulant for faster policy action in the non-US regions, right? So in our tripolar worldview of Asia, Europe, and the Americas, Trump just may be a force of change in Europe to get them to do the things that they need to do in terms of improving their competitiveness, and in China to offset the risk of a very export-focused economy, clearly at risk to 60% tariffs, as President Trump has suggested he might impose on China. Clearly, they have to hedge against that. And so it's kind of an interesting dynamic where the world is priced U.S. assets at very expensive levels, rest of the world, very cheap levels. And, the arbitrage at the moment seems to be, we want more of the expensive stuff, but it might be that the real opportunity here going forward over the next couple of years is going to be in the non-US markets, which are going to move more aggressively to address their competitiveness issues in the case of Europe, or address their exposure as a very export-driven economy in the case of China by stimulating their domestic demand side, which we believe they're already in the process of doing. But that's not yet priced into those markets. And so an interesting dynamic net. We continue to see a positive earnings growth picture for the U.S. and the rest of the world. We continue to see that long cycle playing up in terms of a global economy. Fully employed workforces, synchronized global rate cutting cycle, plenty of liquidity. All those things suggest continued decent price appreciation. So we remain fully invested, overweight equities, overweight commodities, and continue to be deeply underweight bonds, as we have for the last couple of years, completely out of U.S. Treasury exposure, again, as we have for several years. We can get into more detail on the market stuff when we get to that market section, but that's how we're kind of very big picture. That's how we're thinking about it. And we put all of that in the monthly, which was 5,700 words, 31 charts and tables from over 20 distinct separate research sources. And we boiled all that down to a executive summary, which was 1,300 words, and is available to anyone who wants to go on Pelosky.com and pull that piece.
You must be reading my mind, because I was just about to mention Pelosky.com. But as people are aware and how this is all broken down, so many people have seen this by this stage, but we're going to kick it off now with climate. And now, looking at the climate side of it, obviously you talk about the domination on Chinese EVs before. People looked at the history of this sort of side of it. One of the things we haven't really dug deep into is the nuclear power side of it. I'd like to hear more of your thoughts on that.
Yeah, well, as you know, and for folks new to the show, we're really big believers that if you're going to do global macro investing, you need to have a process. And our process is that global risk nexus, which we developed years ago to assess climate. Well, back in the day, it was COVID. Now climate, economics, politics, and policy, and then how it all feeds into the markets from that tripolar world point of view. And that process and the discipline of writing, every week for our musings or once a month for the monthly, is really critical to keeping us at TPW Advisory, kind of on the front foot. And with markets moving very, very quickly, we believe that a combination of process and forward focus is the best way to achieve that elusive goal of investment success, which we all strive for. So climate, it is very interesting. Clearly, and you see even in the news today, we're recording this, I think, a little bit late because we had some conflicts last Friday. But today's big news: Ford laying off thousands of people due to EV issues. BYD, the Chinese EV maker, now dominating the globe, coming seemingly from nowhere a couple of years ago to now be the leading EV producer in China and globally. And so clearly China is now dominates the clean energy renewable space on a global basis. And they did that through the fusing of industrial policy, what we call the new industrial policy of public and private investment on the commanding heights of climate, AI, and defense. And so one of those three has already been, the battle's been fought and already won. China won. And the AI battle is kind of coming at us full force. And that's where nuclear power clearly is coming into play, right? Because the whole AI process and the need for information and data, and thus data centers and their need for consistent, uninterrupted power, which requires a consistent source, which can either be battery if it's through renewables, or natural gas or nuclear power. Nuclear is getting a kind of renewed lease on life. And we saw that with President Biden announcing a major expansion of U.S. nuclear power programs. We've seen that with the idea of tying together data centers and nuclear plants, smaller plants, to basically provide power just for those data centers. Now is being discussed in Europe with EDF in France, being discussed in Japan as well. And so clearly there's a fusing of the AI process and power, and nuclear power is got a big arm up on that front. And it's been really interesting to see, like, in the space of a couple of months, right? I mean, literally 3 months, 2 months, you've gone from nuclear kind of being, some people talking about it. We've been invested for quite some time in uranium miners, but for the most part, it was a side issue. And then boom, all of a sudden, AI, power, nuclear came together like that. And it looks like that's going to be one of the big plays, that you're going to have data centers with power, specific dedicated power generation capacity. So there's a whole lot of excitement around the smaller kind of modular reactors as opposed to the big traditional plants, power nuclear plants. And we'll see how all that goes. It's basically unproven technology at this point. But boy, and there's where you could argue President Trump has actually nominated someone, I believe, to head energy, who is, a energy guy and who is actually on the board of one of those new modular nuclear efforts. And so, who's to say maybe that particular nomination becomes one that helps the U.S. compete on the nuclear and AI front. But other than that, on climate, it's been a rough go with the renewable side, certainly struggling from an equity investment point of view, but lots to be seen in terms of how the nuclear power process works out here.
And to move on to the next section, economics, it's obviously a lot of stuff's changing at the moment. Like, the word inflation is not getting thrown around as much in the US as it was in the past, but now it's starting to come in more so in Asia. And once you go back to your global risk nexus, that's where you factor all this in. But one of the things probably more that the viewers are probably aware of is the word tariffs. How are you seeing that play out?
Yeah, well, that was Trump's favorite word on the campaign trail, right? Tariffs, his favorite word. I mean, history would suggest it's not a great word for the most part. There's a thing called comparative advantage that has been a bedrock of economic philosophy for a couple hundred years. But we'll see how it all plays out. I mean, one thing clearly, Trump has always been focused on trade, focused on tariffs, not even going back to 2016, but way before that. This is an issue, and I think this is important for viewers to understand. This is an issue that he has real deep personal feelings on in a long history of being focused on tariffs and protectionism and feeling like the U.S. gets ripped off. And so, it's going to be really interesting. We've seen it play out just in trying to decide who's going to be the nominee for their Treasury Secretary, right? Because he wants to achieve two things. One, higher stock prices, right? Trump likes to, keep score by how stocks are doing in his administration. The second is he really wants to implement a lot of tariffs because he thinks China and Europe are ripping us off. The problem is that tariffs tend to be inflationary, particularly if you're putting them alongside big tax cuts and labor upheaval. Let's just leave it at that, as opposed to talking about mass deportations. And the worry is on the economic front is that this hothouse effect, an economy, as we touched on, already growing above trend, arguably above potential, getting even faster growth, leading to inflation, which then becomes problematic for interest rates, and then really problematic because the Fed might not be able to cut if higher rates slow the economy. And so this is, the tension. And you're seeing it play out with Treasury Secretary. There have already been 3 or 4 people floated as possible Treasury Secretaries. None of them have made the cut because I think they're recognizing the tension between some of the objectives of the incoming administration. So where do we sit from our point of view? As we said, we're believers that we're in a long cycle of economic expansion on a global basis, that the U.S. has been the leader, notwithstanding the change in the election outcome. The U.S. has been the dominant growth and low inflation story of the developed markets since COVID. And so Trump is inheriting a very healthy economy. Arguably, the one blemish is the fiscal deficit, which is quite high, particularly outside of recession or conflict. And that's a fair point. The worry is that, Trump is going to make it bigger deficit because he wants to expand the tax cuts, which are coming up for debate in 2025. So it's a little bit of a tricky thing, but again, global economy doing well. B of A just laid out its outlook, expects the global economy to grow slightly faster than it did this year. Interestingly, expect U.S. growth to slow from 2.7 to roughly 2, and non-U.S. growth to grow from 3.2 to 3.5% growth next year. And that's what we touched on earlier about the potential for the dynamic to shift in favor of non-U.S. economies, because part of the reason for exceptional valuation of U.S. equities is that the U.S. has been the best growing major economy. But if the U.S. is going to decelerate and the rest of the world accelerate, then maybe that opportunity set starts to shift a little bit. But globally, inflation not a concern. Growth solid for the reasons we touched on: fully employed workforces, global rate cuts, manufacturing cycle starting to pick up. All those things, plenty of liquidity, all supportive. And really the question is going to be what happens with the policy mix within the United States, and what is the response of policymakers outside the United States.
Move on to politics, and obviously everyone's focus has been on the U.S. election. It's like the whole world is focused on it, but now that's done. So where do we head to next? And obviously, I shouldn't say obviously, but you've got the US have now supplied the missile for fire into Russia. You've got the UK or Great Britain just did that as well. And there's a lot of conflict going on in that space. Like maybe all the attention now goes to Europe.
And that would be kind of one of the things that we touched on in our monthly is that Europe is the region in our tripolar world of Asia, Europe, and the Americas. Asia is pretty well set, right? China dominates Asia. Interestingly, when people talk about trade, what is not yet well understood, and we have a great chart in our monthly, is that China now exports more to Southeast Asia than it does to the United States. So China is already hedging its U.S. exposure, and we think it's hedging more going forward as it tries to stimulate domestic demand to reduce the export dependency it has in its economy, which right now exports drive the Chinese economy. And so that's Asia, pretty well set. Japan moving out of deflation into inflation. That's an improving story. Their growth should pick up next year. So the U.S. we've touched on enough. So what about Europe, right? Europe is the whipping boy for all the people who say, Trump is gonna slap tariffs on Europe. Europe is really the loser in all of this. And I think there's, the risk of that being accurate. The point for investors is that arguably it's in the price, right? For investors, it's not just the story, it's what's priced in. And, the US Europe valuation differential is at record wides. So arguably, Europe as a loser in a Trump-led US world is already priced in. And so you have to think about it. You could argue that point, but the valuation gap, again, we have a great chart on that in the monthly as well, is not debatable. It's a fact. So what we're looking for in Europe is we're watching Germany very, very carefully for a couple reasons, right? One, Germany is traditionally the powerhouse in Europe. Now it's become the sick man of Europe again. Its economy hasn't really grown for a couple of years. They really did a poor job of not investing in their economy over the last decade or so, in part because Germany has this mindset that they want to have very low inflation and they want to have very low fiscal deficits. So there's something called the debt brake, where they are not allowed constitutionally in Germany to have a budget deficit above a certain very low level. And so, unlike in the US, where we've had a big fiscal deficit and we've invested in things like the CHIPS Act, the Infrastructure Act, Inflation Reduction Act, et cetera, Germany's had none of that. And so their economy effectively hasn't grown for several years. And now the government has fallen. So there's going to be new elections in Germany in early February. And we're watching for a change in leadership there that could really lead to a much more aggressive investment cycle, and which could then signal to the rest of Europe, okay, things are ready to move. And part of the important point here is that the blueprint is well known. 2 months ago, Mario Draghi released the competitiveness report. What does Europe need to do to be competitive? It's all right there. It's a question of political will. And if that will is grasped and utilized, then Europe could pick up, and that could be the real surprise. And so right now, as an investor, I think one needs to think about, hey, maybe this is an area where we should be looking for some opportunity. Certainly, on our view, we are really focused on Germany and the political environment there for the next couple of months, because we think that could be a real key.
Move on to policy, and there could be a lot of moving parts going on with this over the next few months, that's for sure. You even say 6 months. There's so much I could ask you a question about on this, but I think I might just cut to you to be like, all right, what are your highlights from it? I honestly, I could
Come
ask 10
on.
different questions.
Hey, you gotta start earning your keep. You gotta be able to have a couple questions there, my friend. But for now, okay, I'll take the challenge. I accept, and I will do my best. And you're right, no shortage of things to talk about, right? So, but importantly, importantly, we want to keep in mind a couple of big points. One is that, we have that new industrial policy that we touched on earlier. We can't stress enough how important we believe this is to the future. That idea of public and private investment and expertise to conquer and compete in the heights of the global economy around climate, around AI, around infrastructure, around investment, and around defense. And that is really the driver. Our view, again, not shared by everybody, but our view is that the countries and regions that get that process right are going to be the ones who will lead in the next decade or so. And so we make a pretty big point about China utilizing this policy mix to dominate the clean energy space, which is one of the biggest global industries out there and becoming only more important. China dominates the entire space from wind to solar to EVs to batteries because they put this process in place. In our worldview, Biden-Harris with, again, the CHIPS, Infrastructure, Inflation Reduction Act is the U.S. response, okay? And now Europe has to figure out its response. Otherwise, it's going to fall pretty quickly behind the other two regions in that tripolar worldview. So that's really the most important overarching point from our point of view. So that suggests to us that we're going to have continued government spending, fiscal spending. We have a synchronized global rate cutting cycle underway. That's likely to be sustained. Quite possible that the U.S. rate cutting cycle slows down. We don't see that as a negative, right? A slow rate cutting cycle historically is good for equities because it means the Fed is not worried about recession, right? If the Fed is cutting fast, it's because they're worried about recession. And when the Fed cuts and there's a recession, stocks go down. When the Fed cuts without recession, stocks do fine. And we think that's the environment that we're in. We don't really expect much in the way of spending cuts in the U.S. A lot of talk about the DOGE committee and all the rest of it. Reality is that, in terms of the overall budget, the discretionary monies that are not already allocated for social spending or interest expense, et cetera, is quite small. And given that the House majority is likewise going to be very small for the Trump administration, we don't really see big spending cuts or, frankly, big tax cuts getting through the House. Really, where we think, notwithstanding all the discussion around what Trump wants to do, as we touched on earlier, we think the bigger policy changes are going to be outside the U.S. And this is definitely not a common point of view. But our point of view is that the policy action is going to be greater in the next couple of years in Europe and in Asia, particularly in China, than in the U.S. And if we're wrong on that, then it's going to, we'll obviously have to recalibrate. But for now, we see Trump has desired to be aggressive, but as we said in our title, policy continuity in the U.S., we think there's not as much room, either governmentally or fiscally, for the new administration to move as aggressively as they campaigned they would move, right? And that's not unusual, right? Lots and lots of governments say lots and lots of stuff on the political campaign trail, and then once they get into office, it's they have to downsize a lot of that because it's just not feasible. And I think that's probably going to be the case in the U.S. Huge spending cuts, highly unlikely. Big tax cuts, highly unlikely. Big tariffs, possibly, because the president can act unilaterally there, much more so than in other things. And also on the immigration front, presidents have more latitude to act independently on those two fronts than they do in matters of spending, which is traditionally, Congress controls the purse, right? That's the old saying. And so tariffs and immigration is where Trump may decide he really wants to push. And again, as we said earlier, those tend to be inflationary. If you gum up the works of the labor force, then wages and labor becomes more expensive. If you slap on big tariffs, things become more expensive. More expensive means higher inflation, higher rates, not necessarily great for equities.
All right, and then we always do. We wrap this up with markets, and I listen. Everyone I'm talking to, I think, has similar thoughts to you. This market stays strong. I noted in your note about talking about the VIX collapse. Everyone's been talking about that as well. So why don't we just wrap this up in the next few minutes and give us your view on the markets, Jay?
I'm already tired from already doing all the other talking. God, there's a lot to get through, and it reminds me of how much work it is to get these monthlies done. I mean, it really is a big lift, but again, the value is in the work, right? All of us as professionals, we know the value is in the work, and so we see it tactically. We think markets can continue, risk assets can continue to do well. Seasonally, we're in the best part of the year. Typically, stocks do well right through inauguration. So that's seasonality is in our favor. We talked about earnings growth. Earnings in Q3 came in better than expected. That's supportive. Forward earnings estimates. Just saw something from the Carson Group, new all-time high on 12-month forward earnings estimates for the S&P. So that's supportive as we go forward. The Fed, whether the Fed cuts in December or not, we don't think is a very big deal, as we just discussed. But we look at, those factors, and then we add in the fact that we have the year end, right? And we know that active managers are underperforming, and the election week was a great example of why they underperform, because in 1 week the S&P was up 5%. And if you had any cash, you were underperforming. And most people had de-risked going into the election. That's why the VIX collapse was so important, because that's what really stimulated the pop. Not so much, in our view, not so much the outcome, other than the fact it was a peaceful outcome, and all the fear about contested election just whoop, went right out of the market. The VIX had a 20% drop in a day, and stocks reacted. End of story. So short term, tactically, we continue to think that there's room for appreciation. Markets back in filling. That's pretty healthy because things got kind of crazed after that week of the election. That's all good. Strategically, we talk about, again, year 3 of a bull market, just entering year 3, and like month 25 right now, I think, fits in very nicely with the long economic cycle. Those two things together are what make us really constructive on a multi-year view. That we've timed up a bull market and a global growth cycle that are both in sync. And that should mean that earnings can continue to grow. And as long as earnings continue to grow, stocks should do fine. And it's really important to note in the context, though, like, okay, where do we want to put our chips? Is that year 3 of a bull market in the US tends to be a rest year. Average returns 5 to 7%. Keep in mind the US S&P has been up 24% or so in 23, and I don't even know what we are today, 25, 26%, 24. Not normal to have a third year of 20% plus gains. So it would make a lot of sense, in our view, that given the valuation, there's no room for multiple expansion, really, in the U.S. equity market. So it's all about the earnings growth. And right now, earnings growth estimates are for double digits next year in the U.S. So, as we were saying, right, the U.S. is pressed for exceptional outcomes, fully valued. And by the way, we talked about premium valuation. Another little tell is that the U.S. now represents something like 67% of ACWI, right, All Country World Index, whereas in 2017, a lot of people are saying we're just going to replay Trump, 1.0. 2017, the U.S. represented 50% of the ACWI. Okay, U.S. Traded at 16 times earnings in early 2017. Now we're at 22, 23 times. A lot of differences, and importantly, just encourage investors to really don't just fall for the fact that this is a repeat of Trump 1.0. Do your homework. So one thing we would also say as a reminder, right, in this long cycle thesis, we want to buy the laggards. And so we're thinking about things like thematics like fintech, like cyber, like robotics, okay? We want to be in small caps, which give us a little bit of a hedge against tariffs, right? Because small caps typically not really impacted by tariffs. So that's something to keep in mind. We want to look abroad, as we discussed, and we think emerging markets could really be the place for the next couple of years. And so we have China, and our China tech play there is just one example. Also, Latin America, which has really been not a good place this year, we think could be increasingly of interest as well. So that's kind of the equity play. Non-equities, we remain overweight commodities. Again, thesis being global growth cycle. We want to be long energy. We want to be long the miners. The idea of the power issue in the AI world. So we're looking at copper, looking at uranium, as we discussed earlier. So we continue to be involved in commodities, overweight commodities in our global multi-asset model, and then deeply underweight fixed income, right? We don't really see in the environment we're talking about, that industrial policy world, fiscal spending. We don't really see an exciting environment for bonds, particularly government bonds, and particularly in the U.S., right? So we're zero-weighted treasuries at 4.5% on the 10-year. Is it a huge sell? Probably not. But there is the issue of the hothouse effect potentially in the U.S. And could 10-year go up towards 5? Absolutely. Is it more likely to hit 5 before it hits 3? We definitely think that's the course of action. So we continue to be focused on corporate credit. In the credit market, again, has been a great tell, suggesting the economy is fine. We don't have to worry about things. There's no weakness really in the corporate credit space, whether you talk investment grade or high yield or leveraged loans. We're in the leveraged loans in the United States in particular. We're in high yield in some of the emerging markets, as well as some government debt there, where you're getting paid a much higher premium than in the case of the United States. So wrapping up, tactically, we think there's room to go. Seasonally, great environment, a great time to be long stocks. Chase into year end, particularly in the United States, we think is quite feasible. Strategically, middle of a bull market, middle of a global growth cycle, policy continuity, trumping political discontinuity. That's the title. That's our thesis. And good luck investing, as a friend of mine likes to say.
You stole my line.
I did. I've been doing all the talking. Why should you get to say anything? No, you can talk about markets now. Feel free.
Jay, thank you so much for your time. A great monthly after obviously the big election and so forth. So thank you very much. I'm sure the viewers all appreciate it, and we'll be back talking to you again soon.
Okay, excellent. Take care, Scott.
And for everyone else out there, enjoy this with an Aussie accent. Good luck investing.